Welcome back, my friends. As you may have noticed, speculative investments are having a disastrous year. The Nasdaq Composite has fallen sharply from its all-time high a year ago. For those of you not already familiar, the Nasdaq Composite is one of the most widely followed stock indexes in the US. It is usually one of the three headline indexes that stock market commentators typically cite. The other two are the Dow Jones Industrial Average and the S&P 500. The Nasdaq has a high concentration of companies in the technology sector. And it includes many of the younger, fast-growing tech companies. So, the Nasdaq Composite Index is often viewed as a barometer of how well tech companies are doing in general. If you follow this channel, you already know that layoffs, inflation and rising interest rates are roiling the tech industry. The stock prices of many big tech companies have cratered over the past year, and since January in particular. Tech companies are slowing spending and responding to weakening macroeconomic conditions. Cryptocurrency companies are going bankrupt. FTX declared bankruptcy just this past Friday. Values of cryptocurrencies are collapsing. Questions even arise about whether cryptocurrencies are actually worth anything at all. US home prices are in the midst of a major correction. There seems to be some debate over whether this is just a correction or is it a collapse. Or, is it a slow-motion train wreck in which prices keep slowly trending downward for a long time? House prices in pandemic-era boomtowns and cities that attracted speculators are going to be particularly hard hit. Home builder confidence is collapsing. What does it mean for the value of risk assets? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. The Nasdaq Composite had just peaked in value almost exactly 1 year ago. That all-time high was double its value since the early days of the pandemic. 2021 was a big year for initial public offerings IPO when tech companies' shares were publicly traded for the first time. Electric pickup maker Rivian had a blockbuster IPO. That was just the latest in a record year for new issues. Hiring was booming. Employees of big tech companies were frolicking in the astronomical value of their stock options. What a difference a year makes. None of the 15 most valuable US tech companies has seen its stock value increase since then. Microsoft is down about $700 billion in market capitalization. If you follow this channel, you know that market capitalization for a public company is basically the total value of the enterprise. Shares of Meta have famously fallen by over 70% from their highs. That fall has wiped out over $600 billion in value this year alone. Investors in big tech companies have lost about $7.4 trillion in the last 1 year ago. Aggressive interest rate increases have closed off access to easy capital. Raging inflation has made any company that is merely promising a future profit a lot less valuable today. Shares in cloud companies have plunged. Not to mention any company having to do with cryptocurrency. Tech companies across the industry are cutting costs and laying off employees. Employees joined those hyped pre-IPO companies in droves. New employees took much of their compensation in the form of stock options. That has backfired and they are now deep underwater. At this stage, they can only hope for some kind of future rebound. IPOs this year slowed to a trickle after having huge years in 2020 and 2021. Tech companies thrived during the pandemic. It was a distorted glimpse of an emerging world of work and play from home. And the federal government fanned the flames with government-backed funds. Many unprofitable tech darlings raised billions in initial public offerings. This flooded the coffers of investment banks and venture capital companies. But these unprofitable public companies have all now basically crashed. Some may not even survive. Shares of Rivian have fallen more than 80% from their peak. Rivian reached a stratospheric market capitalization of over $150 billion despite not being profitable. As it turns out, the COVID-19 pandemic did not forever change how live, working, playing, shopping, learning, convening happy hours on Zoom calls, avoiding airplanes, malls and indoor dining. The last time it happened the tech-heavy Nasdaq underperformed this badly was the bursting of the dot-com bubble. From 2000 to 2006, the Nasdaq only outpaced the S&P 500 one time. Is history going to repeat itself? It would not really be a good idea to count Silicon Valley out. or even any of the Silicon Valley lookalikes that have popped up across the globe. Actually, nobody really knows how badly tech companies have miscalculated. 2022 was supposed to be the year of Meta, according to CEO Mark Zuckerberg. Facebook had consistently delivered investors sterling returns until 2021. It consistently beat Wall Street estimates and grew profits with historic speed. But Zuckerberg and Wall Street are now at odds over their visions of the future. Zuckerberg has committed to spending billions of dollars every year on the metaverse. But Wall Street analysts just want the company regain its footing with online ads. But Apple seems to have prevented that with its iOS privacy policy change. It is now harder for Facebook and others to target users with ads on iPhones. Shares in Meta are down 70% and Meta is poised for a third straight quarter of declining revenue. Meta is cutting 13% of its workforce, which is 11,000 employees. "I got this wrong, and I take responsibility for that," Meta CEO Mark Zuckerberg said. Software engineers had gotten used to outsized compensation packages, especially from Meta and Google. Companies offered more than $700,000 for a qualified engineer or project manager. Some top-level engineers could make $1.2 million a year. But those days might be over. Productivity software firm Asana, just as one example, has never been profitable. Yet it was able to go public in 2020. And it offered engineers starting salaries of up to $198,000. Today, those days seem like a distant memory. Cisco cut 5,000 employees. Meta laid off 11,000. Amazon cut 10,000 jobs. And Twitter famously fired 3,700 people. So far in 2022, job cuts at tech companies are over 130,000 workers. HP announced the elimination of 6,000 jobs over the next 3 years. It is a poorly kept secret in Silicon Valley that companies ranging from Google to Meta to Twitter to Uber could achieve similar levels of revenue with far fewer people, said Brad Gerstner, a tech investor at Altimeter Capital. Gerstner has been urging Meta CEO Mark Zuckerberg to slash spending. "I would take it a step further and argue that these incredible companies would run even better and more efficiently without the layers and lethargy that comes with this extreme rate of employee expansion," Gerstner wrote. Activist investor TCI Fund Management told Google CEO Sundar Pichai basically the same thing. Growth at Google has slowed to its lowest rate since 2013. "Our conversations with former executives suggest that the business could be operated more effectively with significantly fewer employees," TCI wrote. Naturally, Google employees are worried that layoffs are imminent. Remember SPACs, the special purpose acquisition companies? If you follow this channel, you already know that SPACs enable companies to go public quickly, bypassing the typical process. They were quite a phenomenon in 2020 and 2021. Investment banks were clamoring to underwrite them. Private investors rushing in with new pools of capital. SPACs enabled companies that did not fit the traditional IPO profile to backdoor their way onto the public market. An unbelievable 619 SPACs went public in 2021 alone. There were only 496 traditional initial public offerings. This year has basically been a disaster for both SPACs and traditional IPOs. The CNBC Post-SPAC Index tracks the stock price performance of SPACs. And that index is down by more than 70% since inception. And it has crashed by 2/3 in 2022 alone. Thankfully, many SPACs never found a merge partner and ended up having to give the money back to investors. The most famous SPAC creator is Chamath Palihapitiya, a Canadian venture capitalist. Palihapitiya shut down 2 deals last month after failing to find suitable merger targets. He then returned $1.6 billion to investors. Venture capitalists spent the past decade minting tech unicorns. Last year, venture capitalists invested $325 billion into venture-backed companies. Needless to say, those days are over. Now venture capital comes on unfavorable terms. "You just don't know what it's going to be like going forward," said venture capital leader Jeff Grabo. VCs are rationalizing their portfolio and supporting those that still clear the hurdle, Grabo continued. Wall Street analysts are now focused on growth of profits and not just revenue. Tech unicorns can no longer count on venture investors to subsidize their growth. And Wall Street analysts no longer value high-growth, high-burn companies. Now it's impossible for many companies to go public without huge haircut to their private valuation. A slowing IPO market informs how earlier stage investors behave, said David Golden, managing partner at Revolution Ventures in San Francisco. When the IPO market becomes more constricted, that circumscribes one's ability to find liquidity through the public market, said Golden. Most early-stage investors aren't counting on an IPO exit, Golden continued. The odds against it are so high, particularly compared against an M&A exit, Golden added. We're reverting to the mean, Golden said. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.